Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 194th VideoCast, 184th podcast for the week ending July 6th, 2023. I hope everyone had a wonderful Independence Day and a nice long weekend. Here are a few pictures. We got to enjoy the fireworks at the club. There's Mimi and Annabelle. And then we got a couple more here. So it's pretty cool. And then there's Caitlin and me. So also want to thank Ellen Chang for including me in her extensive article on the shift in the market for the second half. We'll go through that in just a bit, but great article over at thestreet.com by Ellen Chang. Also want to remind you on August 8th through the 10th, I will be in Las Vegas. Actually get out on the 7th, looking to play 18 if anyone's out there that might be interested in playing. Their tickets are 50% off right now. So you're going to see Fox Business's Charles Payne. I believe he speaks on the same morning that I do. Tom Lee of Fundstrat, who's fantastic. My buddy Kenny Polcari, Keith Fitzgerald, and Meb Faber. So really an all-star cast. You definitely want to check that out. This one is exclusively for accredited investors. So if you're accredited, you know what that is. And take advantage if you want to do that. Our quote of the week is from Seth Klarman. Successful investors tend to be unemotional, allowing the greed and fear of others to play into their hands. By having confidence in their own analysis and judgment, they respond to market forces not with blind emotion, but with calculated reason. Successful investors, for example, demonstrate caution in frothy markets and steadfast conviction in panicky ones. Indeed, the very way an investor views the market and its price fluctuations is a key factor in his or her ultimate investment success or failure. That's from Seth Klarman, value investing legend. And speaking of panicky markets today, what's everyone worried about? You had these big job numbers, which has everyone scared that the Fed is going to raise rates in July and then again in September. And as a result, you saw the 10-year yield spike all the way up to 4.03 today, which is below last October highs of 4.33, which was near the stock market lows. And it seems to have backed off a little bit towards the end of the day. We're going to explain to you why we're not worried about that, and we think this may in fact be the top. Which is interesting here, lower high, lower high. So let's see how that plays out. As it relates to BABA, still more questions on BABA, but again, ladies and gentlemen, same as last week, it's in this normal bottoming process, still in this range here, may go back and touch 80 before it takes off, but no change. If anything, the business is getting stronger, which we're excited about. We know from the 618 retail numbers. We know from the expansion of Freshippo ahead of the IPO. We know their new expansion in Spain. We'll get through some of this stuff, but ignore the noise. Ignore Yellen going to China, new central bank chairman, Xi going to Russia. All this stuff that we keep tabs on means absolutely nothing. All we care about is buying durable, high-quality cash flows when they're dramatically underpriced. And that's exactly what we have with Alibaba. So on the 10-year note, while everyone gets scared about interest rates, we know what's coming next week in our view. And here's all you need to know. We cover this very frequently, the commitments of traders, which is the green line, commercial hedgers. They're always early and they're always right. And what are they telling us about treasury notes? The same thing that they told us in September of 2018 when they were buying the hell out of it ahead of the bottom. And then you got a monster year and a half rally in treasury bonds, which means a compression in yields. And the same thing is happening right now. They've been buying the hell out of it during this bottoming process, and we're going to see a rally in bonds and a compression in yields. And that, which is the exact opposite of what everyone's betting on today. And that's going to create the environment for the shift, the sea change shift of outperformance that we talked about in recent weeks that started in June and is going to persist in the second half of this year. So we're very excited about this call today. You can see here today a couple of these things, this NAAD, NYAD, NYSE advanced decline, and the NASDAQ advanced decline. It's well below levels where you get monster short-term bounces. So it wouldn't surprise me tomorrow if we got to rip your face off rally off the jobs number because there's some distortions in the ADP number, or if we have to wait till Tuesday to get the inflation numbers that we've been talking about, that'd be fine by me. But either way, this is at a short-term extreme. Moving along, one of the things that we like to look at, because sentiment is a little bit stretched, which we covered in the article of the week today, but there's always stuff to do. And when you step back from a secular point of view, we think that conditions are ripe for the next 10 years from a demographic point of view, that we're still in the second half of a secular bull market, which tends to last 18, 19 years. And we're going to talk about that a little later today. But just, on simple screens that we do, there's always stuff to do. Now, you're all getting your pen and paper. Oh, these are all the names he's looking at. No, this is a screen that I'm looking at. But, I take a longer term view. These are monthly charts, and I take a look at what's beat down, and then I go through one by one. What do we want to own? And some of these are new positions that are already up in the last few months, like Baxter. But you can see here, while everyone thinks that everything's breaking out to new highs and they missed it because the market rallied 25% off the low, no. Where you'll really feel that is in 2 years, and you say all those opportunities that I had coming out of COVID that Tom was pounding the table on that I didn't take advantage of, just like tech and semiconductors last year, poor me. And I can just tell you, looking at this screen by screen, all right, we own one from this page, and we're looking at 2 or 3 of the names that we haven't done anything yet. Next page. We are looking at, we definitely own one, Alibaba, and we're looking at 1, 2, that looks interesting, 3, 4, 5, own another, own 2, looking at another, 6. So, you only need a portfolio of 10 or 11 stocks to outperform. This is one we've already talked about, Advanced Auto Parts. That's on our radar. Boston Properties, we've got Vornado. So, ladies and gentlemen, there's always stuff to do, and especially right now coming out of COVID. It's just unending, the opportunity that we see. Yeah, there's a few here that we're doing research. We own Vornado. This is the stuff we love. This is exactly what Seth Klarman is talking about in this quote, is you go to where the panic is and you find why there's a temporary impairment. Generac, okay, we had this. We were talking at 101. It ran up to 150. Now it's backing off a little bit to shake out the late money that bought it at 150. And it'll just work its way higher. This has probably another 100 points in the next year, 18 months. That'll be 150% return. And then if you hold it a little longer, it's probably a 200% return over 3.5 years. That's a nice IRR. So, but you're seeing a lot of Chinese names, and you just do this every so often, and there's plenty to do. And then you dig deep down and you do the work, and that's that. As we move into the U.S., though, I do want to play this clip from Tom Lee. Great guy. I had a chance to have dinner with him a few months back, if you remember, through one of our Advid podcast listeners, Philippe, who connected us, and he's friends with Tom. And Tom is saying on Monday exactly what I've been saying for the last few weeks, that we're going to see mid-3, he thinks even low-3 prints, and he's getting at it from a different way that I am. I think it's all going to be in the owner's equivalent rent, which is more than a third, and now working on the lagged 18-month lag right now. I think we're going to see a big 3 handle, and all of this. And then what happens is all this crowd into this certainty, 90% on the Fed funds futures that they're going to hike in July is going to collapse when you see the inflation 3 handle. Why? Because it gives Powell cover. He really can't stop with a 4 handle, even though it's down from 9. If he stops at a 4 handle and it goes up to 6 after his complete disaster with transients, I mean, the guy is going to be toast. So he needs the strong 3. He knows the lagged effect. So I think we're in good shape as that plays out. But what I want you to do is listen to Tom, because he's got some strong S&P targets. And I don't disagree. He's a hair more bullish than we are for this year, but I think he's going to be right. And for me, the indices aren't that important. I think the sectors and the groups and the companies that we're looking at are going to dramatically outperform anything related to the indices anyway, but in the second half. But take a listen.
Welcome. It's good to see you again.
Great to see you, Scott.
So how timely. You just raised your S&P target to 4825. So you were a little too bullish last year, and you think you're not bullish enough for this year.
Yeah. Yeah, we're at the midpoint of the year. We took a look at what could happen in the next 6 months, and I think there are some positive catalysts coming up, including, inflation next month. The June CPI could fall to 3%. It really takes the pressure off the Fed. We've got the generative AI story that I think is gaining traction, and I know there's a lot of skepticism of this market, but advanced decline line hit an all-time high last week. So I think we build upon those gains, and we set new highs this year.
Are you sympathetic to the skepticism that you say still exists? Why do you think people are still so skeptical of a rally you think can keep going quite substantially?
Yeah, I think I understand why investors are skeptical, because we're in a hike cycle and the curve's inverted. But our view has been that this has been an inflation war. So the Fed's not trying to kill the economy, it's trying to kill inflation, and I think they're winning. I think it is still going to be a tough battle. First half was a game of inches. It wasn't like the stocks went up every week, but I do think we're in a buy the dip regime. So I think it's still a street fight, but the bulls getting the upper hand, and we gain maybe 8, maybe as much as 12%.
Do you think the Fed thinks that you can do one without the other in terms of killing inflation without killing the economy? Because every time you hear Jay Powell and whoever else related with the Fed talk, they mention how the labor market is still strong, arguably too strong for their liking. Consumer is still too strong, maybe for their liking. And the economy itself is hanging in there, I think, a lot better than even they expected it would.
Yes, I think the Fed has an optics issue because, 4% inflation doesn't look good for them. But the internals of inflation are really encouraging. Goldman had a nice piece today looking at that. And first of all, used car prices, which have been really pushing inflation, are set to roll over. That has nothing to do with the stock market. Housing is finally starting to kind of catch up and will start to reflect market prices. That's rolling over. That has nothing to do with the stock market. The labor market's cooled off a lot. We'll get the JOLTS report this week, but average hourly earnings are growing at half the rate it was last year, and 4%. That's where the Fed would like it, and that has nothing to do with the stock market.
I understand, but I mean, the idea that services inflation is still too sticky for the Fed's liking has nothing to do with any of the things that you just mentioned that have come down a lot. And that seems to be the problem that the Fed has and why they're so apparently resolute in the way they talk about what they're still going to do.
That's right. Now 7 items make up services. And, core services ex housing is running actually a pretty decent rate right now, like in the high 2s. But financial services is being inflated because of higher interest rates. Travel could have a seasonal problem that's being fixed in the next 2 months. Because as we know, like when you look at things like airline demand, I mean, their prices are cooling, even though it still looks like they're inflating. And then restaurants is tough, but that I don't know if the Fed wants to kill the economy just to get restaurant prices down.
But they need to kill demand to some degree. At least that's what they would suggest. And that's what, Jay Powell seems to refer to anytime he makes comments about what's going to be ahead. Hike in July, maybe there's another hike this year, all because they're not satisfied that they are full enough into what they would deem to be restrictive territory.
That's right. I think that they're going to have an easier PR story after the June CPI comes out next week, because headline CPI will be down to 3, now people can start to believe there's real progress because you've gone from 9 to 3 on inflation. And then they can argue that a lot of the 500 basis points of hikes is still going to kick in. So I don't know if there's the urgency to keep hitting with 25 basis point hikes.
Yeah.
And we're back. So that creates a good context for today's call with Tom there. And here are some U.S. Headlines we want to just quickly touch on before we get to the article of the week. Fed's preferred gauge shows lowest annual inflation since April of 2021. Wall Street still expects a rate hike. Wait until they get the real inflation numbers next week. And that narrative is going to be burst in our view. Real estate stocks are on sale. Where to find the best deals. This Barron's article is about commercial real estate. So opinion follows trend. Obviously, Vernato's moved up a lot. Boston Properties, et cetera. And people are like, why is that happening? And then they have to justify it. And then all of a sudden you get the headlines and you get the interest, and it works the same way. Opinion follows trend. Market rally will shift to small caps, REITs, and biotech. This is the Ellen Chang article. You should check it out on thestreet.com. She really, gave me quite a bit of ink here. And we go into the transition, the sea change that we've been covering in the last few weeks. This is very important here. This is from a retired investment banker. He's got a good blog. His name is Scott Granis, and he lives out on the West Coast. And what he's talking about, I know everyone's been talking about the contraction in money supply, but he makes a really good point this week where he said, and it's this chart here, where you see the long-term 6% trend growth on M2 money supply. We've referenced it multiple times over the last year, but it says chart 1 shows the level of M2 blue line and its 6% annum trend growth rate green line, which has been in place since 1995. According to data released yesterday, M2 increased by $131 billion in May, breaking a 9-month losing streak, totaling just over $1 trillion. M2 has fallen 4% in the last 12 months and is up only 0.9% in the past 24 months. Yet, M2 is still about 2.6 trillion above where it might have been in the absence of the COVID crisis. He says, I've argued that this, quote, extra amount of M2 serves as a cushion against recession because it means that the economy is still flush with cash and liquidity, et cetera, et cetera. And we've talked about this for many, many months as people have been pessimistic and sitting in cash, and the market's now rallied 25%. Next, hedge funds on the brink of abandoning bullish dollar bets. So they're starting to capitulate because the dollar has not gone up. First, they were on the wrong side, and now it's not come back up. So they're kind of getting flushed out, which is a good setup. Wall Street is rooting for an M&A comeback in the second half. This is from Carlton English. We covered this on Yahoo a few weeks ago after the Cava IPO. We think that this is going to be a major source of unexpected earnings power for financials and certainly the money center banks to start with, like Bank of America, which we own, bought in that little mini crisis in March. And also think that the entire group is going to be lifted as this gets blown out of the water to smithereens next week and catches everyone off sides. So we think that people are underestimating that profit center, which basically dried up to zero last year, coming back in the second half. And that will be a boon to the financial sector and will support our rotation theory. We're also including KRE in our rotation theory. So we do think as yields are compressed, we'll get into that in the article of the week. Jacob Sonnenschein over at Barron's is shooting the lights out. He's been doing an incredible job. He put out, a article here, 6 small bank stocks with big upsides. So he's, living the Barron's maxim, and that's what makes him the greatest financial publication in the business, which is taking the unconventional picks, and he's doing it in spades. And I agree with him on some of the small regional banks, as well as big 4 pharma stocks on sale right now because they have a lot of cash and they're going to have to buy out. So we're playing it a different way through biotech, but we've taken a look at Pfizer recently. It's come in a little bit. Amgen is kind of interesting. Gilead might be worth another look, and Bristol Myers we haven't spent any time on yet, but great stuff by Jacob Sonnenschein. You should follow him on Barron's. Google searches for inflation have plunged, and that could mean rising prices aren't a big problem anymore. Nobel economist Paul Krugman says, we agree, and after next week, it's going to be even less of a problem. New York's available office space hits record in second quarter. That's the headline, which I think is a little reckless, because if you read into this, preference among many tenants for trophy or Class A spaces driving rents higher. Okay, and that's been our thesis since day one, that this is very similar to the mall crisis from 4 or 5 years ago when everyone said malls were toast. Well, they were right, half right. B and C malls were toast, but the A properties with the Lululemons and the Apple stores owned by Simon Property did better than ever. And we think the same is true this cycle. Some of the B and C office properties will be toast, which is why we haven't got, we kind of were interested in SL Green. We didn't buy it because they had some B and C exposure, and we bought Vornado, which is all A-class property, and that's starting to move quite a bit already. So here's our Cooper Standard, which has absolutely been a blessing for us this year. New vehicle sales rise an estimated 13% in the first half of the year, completely blowing expectations off. And what I like about what Tom said, which is our basic thesis coming into the year, if you recall from the fall, and you can go back and listen to some of the podcasts, is that we felt used cars were going to be toast and new cars were going to flourish. And Cooper Standard makes its money selling the fuel delivery systems, sealing systems around the doors and windows, and cooling systems, which is why they make higher margin on EVs, that new cars were going to fly because as the supply chain eased up, they would fill up inventories and they would start to offer dealer and manufacturer incentives. And in a used car financing market of 8 or 9 or 10%, if you can come out with a new car and say 0.9% or 1.9%, and I actually posted on Twitter, I was watching, and a Chevy ad came up and it said 0.9% for the Silverado. You can check my Twitter feed. Then there was a lot to do there. So new vehicle sales blew away expectations, up 13% year on year. This is going to continue to accelerate. As I continue to say, the average car is 13.7 years, and in a 6-7% environment, when a dealer offers you free money for something you want anyway, in a non-free money environment, people are just jumping all over it. And that's going to continue for some time until we catch up and probably get back to the average car being 11 years, which would mean we're probably going to have to run plus 20% for 3 or 4 or 5 years to meet the pent-up demand that was unable to be fulfilled during COVID. And now that the incumbents have been forced to produce cheaper, smaller cars, and they can't just produce the high-end Escalades where they make huge margin and the high-end F-150s, but they have to meet the demand, or the Asian competitors will just flood the market like Hyundai and Kia, which we've seen is very, very positive for volume numbers, which helps Cooper Standard, which is why we think Cooper's just getting started. So even after it's up, almost 3x since we put it on, I think it's in the 14s today. I think it's one of the few stocks that's up today, which is pretty exciting. All right, some Fed officials supported raising rates in June. So this is the Fed whisperer Tim Arrayos telling us what we already knew. I think that's going to change. You can kind of tell from the last month that Powell would like, he is worried about financial stability after almost, taking out 2 banks, 2 of the 4. 2 should have gone under, but 2 really shouldn't have. He destroyed really good banks. And he's concerned about that because those are real jobs, those are real communities, those affect real small businesses. So he wants to pause, but that data needs to show up next week to give him cover, because so far the data we saw today Market interpreted it, despite it being ADP, which is a mixed bag. And they also changed how they calculated, by the way. This was the first time that they put out a number with their new calculation strategy. So I think tomorrow is going to be an interesting tell. I don't know if it's going to be a catalyst, but certainly we're looking to the inflation numbers next week. Moving along on to China, there was an analyst out this week taking the other side from Clock Tower Research, actually laying out what similar to what we've been saying, but in a different way. So we're going to start our Chinese updates with his short segment with Melissa Lee. So take a listen here.
Markets are poised for a breakout of Beijing moves to stimulus. Joining us now, Clock Tower Group Chief Strategist Marco Papich. Marco, great to have you with us.
Thank you so much, Melissa. Great to be with you.
I'm sure you heard Seema's report. Why are you bullish? And is it just predicated on the notion that Beijing might have a stimulus program in sight?
So first of all, the investment bank community got China massively wrong since Q4 of last year. First, they were extremely bearish, didn't think zero COVID could be pivoted from within days. China proved them wrong. It pivoted away from its policy. And then everybody turned massively bullish, completely forgetting that what ails China is the over-leveraged private sector. I mean, their households are extremely indebted. So what China needs to do is pick up some of that leverage, put it on the public side. And we expect that to happen over the next several quarters. They're going to replicate basically the sequence of events that we in the US used from 2010 to 2016. First cuts in interest rates, then QE, then fiscal. And I think that's more important than geopolitics or chips.
At the same time, let's say they got everything right in terms of the call from the pivot away from COVID zero. I mean, MSCI China in the first half of the year is down 6%. So it's not like you would have gotten a great return if you had said, you know what, those guys are wrong, and this is our view. You're still down 6%. So what do you see picking up Chinese equities in the second half?
Well, no, what I'm saying is the investment banks were way too bullish, thinking that it's just zero COVID. Just removing zero COVID was going to be enough. It's not. They need much more stimulus on the real estate side, but they also need to do basically fiscal stimulus over the next 6 to 12 months. And I think what we're seeing is Chinese policymakers starting to be pushed into that direction. They're starting to talk about like Richard Ku's thesis of balance sheet recession. They're talking about Japanification of China. The things that are kind of permanent and secular, and they need to fight against that with more significant stimulus. So what I would be doing is watching those stimulus announcements more than like Yellen's visit, because I agree with your report, which is that it's very difficult to have any movement in U.S.-China relationship.
Do you think the next couple of years are going to be, in terms of U.S.-China relations, going to be more or less hawkish than you think consensus is?
I think probably less hawkish than the consensus, because the consensus is basically we're near World War III. However, at the same time, I don't see how we actually move before the U.S. election. And you saw this. Blinken made the visit, very high-profile visit, a lot of hope of talk. And then President Biden made a statement about President Xi, which I don't think was a mistake. I mean, that was for domestic purposes in the U.S. I think U.S. domestic politics is driving this rivalry, and it's very difficult for President Biden to pivot in any significant way before he secures his second term.
So does it not matter what U.S.-China relations are for your call to be bullish Chinese equities? Or at a point, does it matter? Do you start saying, you know what, that is a risk and it should be embedded in the valuation? There should be a discount.
Well, so what I would say, Melissa, is that it has mattered. It has mattered massively over the last 18, 24 months. For example, performance of Indian equities is in many ways related to this flight of large pools of capital out of China. So geopolitics has played its role, but at the same time, it's already in the past. Now, all investors who were going to sell China because of U.S.-China tensions have kind of sold it. What's waiting on the sidelines are non-U.S. Investors. There's plenty of them, and they're more than willing to buy Chinese assets if they see that our thesis is right. And what's my thesis is that there will be stimulus in China. So, those folks, Middle Eastern, large pools of capital, European, Southeast Asian, they don't care about Yellen's visit. Quite frankly, they don't care about U.S. policy at all. They care about whether Beijing stimulates or not.
So at Clock Tower, are you seeing inflows from these areas wanting to invest in
No.
China, asking you to? No. Okay.
No, because they're waiting for policymakers in China to actually do something. And everyone's lost a lot of faith in policymakers in China because of what happened in Q1. As you pointed out, zero COVID ended, nothing happened. And I think that that's where, Chinese policymakers have to prove that they are sensitive to the fact that what they're facing is secular stagnation. They're facing the decades that America experienced last cycle. So they need to push against secular stagnation the way that the US did, which is interest rate cuts, eventually pushed into QE, eventually fiscal. But they don't have 7 years to figure that out. They need to do that in the next 6 months. And because of political constraints in China, we expect them to basically do that over the next 6 to 12 months.
Right. Marco, thanks.
And we're back. So that's kind of context. Nothing tremendously new there, but just kind of said in a different way. Here's some of the updates for the week. Chinese e-commerce giant Alibaba expands the number of physical grocery stores ahead of its unit's IPO. China's jobless youths may pose political risk, top advisor says. Now, if you remember, they flipped on COVID lockdowns to COVID zero after they started riots in the street. Well, young Chinese unemployment is at an all-time high, about 21%. And those are the people you don't want to piss off because, 50-year-olds don't go out in the street and start burning signs and kicking cars. It's the 20 and 25-year-olds that go bananas when they can't get a job and they don't have hope in the future. And that's kind of where they are right now. Now, Jason Patel sent me some interesting data showing the cyclicality of youth unemployment peaks every summer. But it's kind of extreme here. So all of the pressure is on the Chinese to do massive stimulus. And I think they're just waiting out to see what Yellen has to say this week and see if they can come to some positive resolution on some of this trade stuff and then make a decision on how big they want to go. Because, or they could do it like COVID and just wait for the riots to happen in the streets before they put a big fiscal bazooka out and absolutely blow the doors off and shock and awe everyone. And the thing, you wake up and you see the Hang Seng up, 9% overnight, and you're like, oh my God, I missed it. China, blah, blah, blah. So it's coming. We don't know when, but it's kind of getting to an acute point, and these are some good catalysts that drive it. Let's see, we covered that. China banks cut rates for 453 billion corporate dollar deposits. They're doing this kind of like half measure stuff. And I like this article in Zero Hedge. Every week we cover, they cut rates 10 basis points. It's like, just, S or get off the pot at some point. So Beijing needs a spending binge to bring back growth. This is from George Lee at Bloomberg Markets via Tyler Durden at Zero Hedge. And it says there's been no official announcement since then, but a chorus of experts at home and abroad are calling for more aggressive fiscal relief for Chinese business and consumers. Last month, Dow Jones reported that policymakers were weighing the issuance of special treasury bonds worth $1 trillion yuan or 138 billion to help fund new infrastructure projects. That would be a bazooka. So it's in the works. And this was a Zoolander little meme. What is this? A stimulus for ants? We agree. So they'll do it. The question is, do these 20-year-olds... And by the way, the reason the 20-year-olds are in the street is that it's a lagged effect of the China crackdown on tech last year, because that's who was hiring them all. And instead, they've all leaned down. So when the stimulus comes, it's just going to go straight to the bottom line, which is going to be great for us. So we're just waiting until that happens. It's the same thing with the Fed when they get out of the way. All this stuff is lined up, and we see it in the commercials in terms of their positioning in treasuries. It's all linked together. It's like the pieces of the puzzle make a beautiful painting. And we've got pretty much 93% of the pieces in place. Last 6 or 7% will go in place. And all of a sudden you'll see this beautiful painting. You'll say, oh, that's what he was talking about. I had no idea it was a Monet. So trust me, we're working on a Monet. We're not looking at, some scribble type of thing that your 3-year-old might put together. I'm sure it's beautiful, but it's not a Monet. All right, U.S. wants to limit China's access to cloud services from Amazon and Microsoft. This is a boon for Alibaba because all the Chinese companies that are using any of them using Amazon and Microsoft are now going to be forced to use a Chinese company. And if you're a Chinese company, are you going to want to use you're going to want to use the biggest and the best, with Alibaba at a 38% share, and they're going to get the benefit of that. So thank you to the U.S. for helping our Alibaba position. China PBOC eyes stability amid recovery woes. So they've got a new central bank head. All right, so the pieces are going in one by one. We'd love them to go in faster, but they're there. It's just going to be can't start a fire without a spark, the old song. Maybe it'll be these 20-year-olds. Maybe it'll be Yellen leaving, but they're there. They got it. They got to act. We know that they're taking actions in the background to set the stage to do it. So I don't know if it's tomorrow or next week or next month, but it's coming. Janet Yellen arrives in Beijing on mission to find common ground for U.S. and China. And our article of the week, which is the secret to happiness is low expectations. Stock market and sentiment results. There's an old maxim, the secret to happiness is low expectations. This saying could not apply more directly than to what we are seeing coming into Q2 earnings season. And I'm glad to see a little weakness, for heaven's sake, because there's been absolutely zero for a long time. I like to see that coming into earnings season. I don't know if that'll persist next week if we get the inflation print I expect. But anyway, with consensus expectations looking as pessimistic as they were going into Q1 earnings season, the stage is set for another series of positive upside surprises. While Q1 earnings expectations were for negative 6.6% at the beginning of the season, they finished negative 2% by the end, shattering expectations to the upside and forcing analysts to begin modest upward revisions. Q2 earnings season, which starts next week, may prove to be a replay of Q1. Set the expectations bar low, which is currently at negative 6.8% estimated, and then hop, skip, and jump over the very low bar, forcing analysts to panic upgrade and PMs to chase up with leverage. There's one pocket of the market where expectations are currently set high relative to the market in aggregate, where pessimism prevails. This group is the AI-related stocks and tech/Magnificent Seven. They've outperformed in the first half on the basis of these lofty expectations being fulfilled in the near term, but in our view, the likelihood is that, quote, this quote, unquote, new industry emergence will take some time. That does not mean the earnings for the Magnificent Seven will be bad. It simply means we expect the relative outperformance of this group in the second half will pale in comparison to their relative outperformance in the first half. It also doesn't mean that they will do poorly or crash, but it is our expectation that the remaining 93% of the S&P will start to catch a bid, which started in June, by the way, as managers who missed the gains in the first half start to play catch up by buying the laggards they have not missed. So just put yourself in the position of a portfolio manager who hasn't performed, who didn't own Cooper Standard in the first half of the year. And, if you were in cash, like a lot of them were, or in very defensive stocks which haven't performed, or were chasing energy that had already made its move, and you have 0% returns year to date, are you going to buy the things that are up 30%? Well, yeah, I mean, if you're Dumbo, maybe, and there are a lot of those, but more likely than not, you're going to buy those quality businesses that haven't yet moved, that are probably likely the next ones to move, and that's where the opportunity is. So in Q2, analysts lowered expectations for the quarter by 2.9%. This is lower than the average intra-quarter lowering of 3.4% over the last 5 years. And this is all from FactSet. The energy sector has recorded the largest percentage decrease in estimated dollar level earnings of all 11 sectors since the start of the quarter. So they're down another 12.5%, which means negative 47.3, which we warned about in Q4, which everyone's been chasing. I don't think in aggregate these names have come down enough to reflect that weakness, but I do think if cyclicals work, they'll probably do okay in the second half. So I'm less, I've been negative on energy for the last 6 months, since Q4 of last year when everyone was super excited. Not negative, but not interested is basically it. I'm more interested, but I'm not doing anything. They just haven't come down enough that it interests me. They're just better things to do, even if they work a little bit in the second half. Same with materials. They're expected to be negative 30.6. There's nothing I totally love in that group yet. Maybe nothing I really love. Consumer discretionary is expected to report the highest earnings growth of all 11 sectors. If you remember in Q4, we were talking discretionary, communication services, and tech, and semis, which is part of infotech. So they're expected to grow at 26.1. However, if you back out Amazon, they're expected to grow 5.5. So we do think Amazon could probably run into year end. We own that one, and Google. Google probably may take a breather for a little bit, but communication services is expected to report the second largest earnings growth of all 11 at plus 12.6%. Warner Brothers, Disney, and T-Mobile are predicted to be the largest contributors. And then finally, the consensus bottom-up target price for the S&P 500 12 months out is 48.13. Tom Lee has it for the end of the year. Split the baby, 9 months out, if you're at 4,800 and you're still in cash, you're toast. So the key is if the market's going to go up another 9%, whether it's in 6 months or 12 months, who really cares? What groups, forget buying the indices because 9% isn't that exciting. What groups, companies, stocks are going to dramatically outperform that haven't performed yet? And that's the basis of what we've been talking about since the beginning of June, which has already started to play out with small caps in June and REITs, and then the others are going to come on board. So what they're saying here is at the sector level, energy is expected to see the largest price increase because they're the most beaten down, as this sector has the largest upside difference between the bottom-up target price and the closing price. If you're going to play here, and I've said this before, I'd probably play in some of the natural gas names and the servicers, not the integrateds or most of the exploration and production. But okay. On the other hand, consumer discretionary and information technology are sectors expected to see the smallest price increases, as these two sectors have had the smallest upside differences between the bottom-up target price and the closing price. And that's where we talk about underperformance. They're still going up, but not as much as the ones that haven't gone up yet, in our view. As we stated in previous notes and media appearances, besides emerging markets being a major beneficiary of a resumption of the downtrend in the US dollar in the second half, multinationals with greater than 50% of their revenues abroad will have an enormous tailwind moving forward, just as they had a headwind looking backward. So you see here in this table from FactSet, those S&P companies that had less than 50% of their revenues in the US, they were down, their earnings growth was down 10%. So if they had more than 50% of their revenues abroad, their total earnings growth was down 10% because of the lagged effects of the strong dollar, which only topped in October, and that takes some time to work through. Those companies that had greater than 50% of their revenue in the US, i.e. less international or less strong dollar exposure, had earnings growth in the first quarter of plus 2.6%. Same story with revenue growth. This is going to be flipped on its head in the second half as the dollar continues its softness and it works through the system. Now, on June 1st, we laid out the case that we were on the cusp of a major, quote, sea change, and we would see the following sectors begin to participate. Quote, we're on the cusp of a sea change, and the knock-on effects will be material. We expect to see two meaningful changes in the coming months as a result of the Fed being done. Number one, the dollar will resume its downtrend after a debt ceiling safe haven bid in recent weeks. So that was the bid. It's backed off a little bit. And the most directly impacted asset classes from this development will be the groups that have been left behind in the recent rally. Number one, emerging markets in China will resume the uptrend they began in October. China trades inversely with the US dollar and is the heaviest weighting of the emerging markets indexes. So I have here emerging markets, which looks, the EEM looks exactly like the Alibaba chart. They all look the same until they don't. When this starts working, this will work more. The BABA chart will work more than the emerging markets chart or the China chart. B, biotech will accelerate its slow recovery from last May's lows as risk comes back into the market. What do you need? You need a bid in the treasuries to get this thing booming, and that's going to happen. And C, any multinational company with revenues abroad will increase earnings materially as the U.S. dollar weakens. Roughly 40% of the S&P revenues are generated outside the U.S. For example, Intel gets 82% of their revenues from outside of the U.S., 3M gets 49% of revenues, PayPal gets 47%, VF Corp gets 45%, Stanley Black & Decker gets 45%, Baxter gets 45%. 2, long-term treasuries will begin to get bid after a few weeks of heavy issuance following the debt deal. So they did the debt deal mid-June, and guess what? They need to issue $1 trillion of bonds. That's probably some part of the increase of the 10-year yield to the 4%, putting a bunch of supply on the market. That'll dry up soon. Interest rate sensitive sectors will get bid. 1, REITs. They've already started to get bid. 2, REITs have been left for dead. As the long end of the curve gets bid and yet rates come down, you'll see this begin to recover. 2, banks. Banks will start to get bid again as their portfolio and loan book mark-to-market improves, reducing the need to raise capital. Funding costs will begin to moderate as deposit rates become more competitive to alternatives. And C, small caps will get bid as banks begin to recover. We saw this in June. They have been a major laggard this year. While this move began in earnest in the month of June with REITs and small caps leading the way, the remainder of the thesis will play out through the second half. We pounded the table for tech and semis in late fall and early winter 2022 when no one wanted them. They led the way in the first half. And while we think tech will underperform on a relative basis in the second half, we are not sellers. We are holders, or hodlers, as the crypto community would acknowledge. We are not part of that community, but kudos to them. Many of the indicators we consider show there is still upside in tech until we reach extremes. So you can just look at lows. I have the backdrop against the S&P. It doesn't matter because the S&P is tech weighted anyway. You could do it against the NASDAQ, but you can see here, you putting the bottom in and you get these multi-year rallies, bottom in, multi-year rallies, bottom in, couple years, bottom in, couple years, bottom in, and we're just starting. Same thing with the Equal Advanced Decline Index, bottom in, we're just getting started. All these, the same type of thing. McClellan Summation Index, not at an extreme. Same thing with the Hayes New Highs Index, bottom in, a little choppy on the way up, multi-year rally. Same thing in 2011, 2012, 2019. It's just repeating over and over. Then you've got this Zokaracek method alternative. You don't have to study the roots to pick the fruit. And here you can see when it's at the bottom and it works its way higher, you're at the beginning of a rally. Same thing with this Golden Cross NASDAQ composite. That means the 50 crosses the 200-day. It's nonsense, but when you trace it back through history, it works. So NASDAQ stocks above the 200-day EMA, same thing. Bottom, multi-year rally, bottom, multi-year rally, bottom, 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 just getting started. Same thing with NASDAQ Advanced Decline line. A lot of people point to this as the reason why we should go down, and it's just the opposite. It's the reason showing we've just bottomed. Just in like 2011-12, it takes a little while, downtrend, markets going up, chopping up, and then it gets through this, and then it just continues to persist as the laggards that have not led the early stage of the rally catch up to the leaders, and that's what we've been talking about all podcast long. NASDAQ, Bolton Advanced Decline, you have this downtrend, same thing, same thing, same thing. So you tell me, do you want to be a buyer or a seller when these indicators are at these levels? And you could probably answer that question for yourself. As for small caps starting to outperform, understand one thing. For small caps to work, banks have to work. As you can see, they're 21% weighting, followed by industrials, which there's going to be a lot of opportunity there. And we own some, as well as healthcare. That right there, you're over 55% of the index. You add another 10% with tech, you're at 65%, and so on. So if we are correct that next week's headline inflation print will surprise to the downside, mid to low threes handle, the Fed will be done, US dollar will go down, and bonds will get bid, yields compress. A bid in bonds improves bank balance sheet marks, reduces default expectations, caps funding costs, and begins the yield curve normalization process. Here's the chart we've shown over and over for the last 4 weeks. Shows how changes in housing prices take about 18 months to show up in the CPI through what is called owner's equivalent rent, which in turn comprises about 1/3 of the CPI. Since housing prices have been falling for the past 18 months, or the OER component of the CPI will become negative in coming months, thus subtracting a major portion of upward inflation pressure in the CPI. Some indicators related to constructive small cap outlook. We just covered the NASDAQ, and you can see here, bottom is in, multi-year rally, bottom is in, multi-year rally. 15 and 16 and 11 and 12 look very similar to where we are right now. Again, this is overlaid with the S&P. You could overlay it with the IWM. You'll see the same exact outcome, slightly different magnitude, but here's that magical golden cross of the S&P 600 small cap, and we're just coming off the lows, multi-year rally. Same with the small cap stocks above their 200-day EMA. Bottom is in, multi-year rally, bottom is in, multi-year rally. Financial stocks, which is the major component in the small cap index, same exact thing. Bottom is in, just getting started, multi-year rally. Here's the small cap breadth for everyone saying we can't rally because of breadth. Just the opposite. Breadth is starting to improve. That's when you want to be in, not looking for the rear view mirror, though looking through the rear view mirror. Small cap McClellan summation, same thing, not at an extreme. Then you have the small cap volume McClellan summation, same exact thing, towards the lows, multi-year rally towards the lows, towards the lows. The big picture, while weekly commentary and outlook can be useful as it relates to individual companies and sector rotation, it's important to zoom out and keep the big picture in mind. We've made this case for some time now that we believe we're halfway through a secular rally that that broke out in about 2013 after basically a decade and a half of sideways grinding, just like you saw in the 70s, just like you saw in the 30s and 40s, which is followed by a period of reflation, and we're about halfway through this period. And this is a period, so I think, from 2023 to 2033, it's going to be an incredible time to make money, just like it was in the 50s and 60s and in the 90s. And I think what they don't say here is the demographics is what supports this view, with the largest segment of the population now around age 33. If you look at history for the last 100 years, when they're in housing and family formation, that drives growth, as it did in the early 80s, as it did in the 60s, and as it's doing now. And by the time they turn about 40, early 40s is when that slows down and you want to be out, just like the Japan in the 90s. China will be in the next 3 to 5 years, and you usually get the most parabolic move in the final years before the blow-off top. And that puts the S&P at 14,000 by 2034, based on a normalized rate of return from the lows that you've had the last 2 cycles, and we're nowhere near that yet. Here shows kind of the resistant level for the 10-year yield, which is in line with what we've been talking about. Shows the dollar index weakness, and it shows the cyclical change in sector demand. And we're at the early stages where China and small caps are going to and financials are going to be the outperformers, which is why we've made that shift. One of the reasons why we've made that shift for the second half. The AAIS sentiment has gotten elevated at 46%. Doesn't mean it can't stay pinned. People have been so pessimistic, these things can stay pinned for 6 months. So just because it's up here does not mean it has to collapse immediately, but we'll keep an eye on it. Same with fear and greed, that you have to see some level of chop at these levels, which we're seeing today. And then the National Association of Active Investment Managers, not at extremes, but they're kind of backing off just a hair. Earnings, NASDAQ, top 30 weights in the last 60 days. Earnings estimates have actually gone up by 2.25% for 2023, by 2%, 1.96% for 2024. So that's good to see. And the Dow is the laggard, is down a little bit, but they've done nothing this year. Their performance has been 0. So if any of these companies start getting revised upward, right now, the last 60 days is negative 99 basis points for this year, negative 133 basis points for next year. if we get some upward revisions in this quarter and year to date, the Dow's up like 3%, these all could start to kick in. And what do we have in here? Financials, industrials, et cetera, everything we've been talking about. Moving along, we've got, this is the data that kind of rocked the world this morning, which was the non-farm payroll, ADP, with their new calculation. I think there's going to be a lot more to come on this. The continuing claims are still elevated. It's just the reason is it makes the market worried that the Fed has to do more than we think. And I think when we see the inflation numbers, JOLTS came down. They were lower than expected, so that's actually a positive. But the inflation numbers are really all that matters. We'll see jobs tomorrow, which will be interesting to see how on or off the ADP is. But I don't think that's one you got to lose sleep over tonight. All right, ask me anything questions. And by the way, in this context, there are two things I covered this week that I want you to pay particularly close attention to. And I had a dinner with a close friend who sold his business, and it's probably worth 100 or 200 or whatever. And he's basically, he was talking to me about the podcast and the picks and Generac and all these things. And he's like, you need to scale your business huge, because you can just make an enormous run in the next 5 years and really grow your business. And I've been thinking in the back of my mind, like, we're here, we can have the most monstrous run in the next 10 years and make a lot of people a lot of money and, call it a day 10 years out. And it really hit home. You become who you hang around. And so for those of you, there are quite a few of you who've reached out in the last couple of months for us to take you on as investors. And for one reason or another, we couldn't take you on immediately. Go ahead and check your email today. I think you're going to be very happy with that. And the other thing that I wanted to keep in mind is when things look like, oh, everything's frothy because you're looking at Apple and you're looking at Microsoft, and you step back and you see just how much there is to do and how many quality companies are available that are trading at huge bargain prices. We buy discounted cash flows on sale, period, over and out. And then you look in the context of the big picture, which you can lose on a day-to-day basis, and realize with 82 million millennials at 33 years old, what the future looks like, and capturing not just the S&P going from 4,000 to 14,000 over the next, between now and 2033 or 2034, but actually capturing alpha from not buying the things that are already up 100%, but from buying the quality businesses that are down, and you could dramatically outperform it. I think we're really in a position here to do amazing things, and we're going to scale, and we're going to make it available to more and more people. And the ones that are already in, they have the best terms. New people that come in at those levels are going to be able to also have the same terms at the higher level. And then there'll be opportunities for more and more people to come in and participate in what's going to be the most exciting 10 years. So thanks to my buddy for expanding my thinking a little bit, and kind of all the pieces coming together into a beautiful Monet on this side too, both on the market side and on the business side. So let's get to the Ask Me Anything questions. Hayden Calhoun says, "Hi Tom, I'm a college student with about 1,000 shares of VNO. How high do you believe VNO will go up to, and at what point do you think it would be great to sell?" Also, I was curious, do you have to go to an Ivy League to get hired by Wall Street? All right, well, two things. You can have an idea of intrinsic value on the basis of today's performance and valuations. But once that's met, you have to take another look at how the business is performing on that day and what do the prospects look like at that point. Because the intrinsic value of the business may get a lot better than just reverting back to trend by the time you go to sell it. In simple terms, this is at least a double, and it's probably going to be a triple. But right now, you're probably up on 1,000 shares. You're probably up about $4 or $5 grand based on the date of this. So I missed this one in recent weeks. Do you have to go to an Ivy League? No. Is it an advantage in finance? Yes. Is it an advantage in starting a business and being an entrepreneur and making 100 or 200 or 500 million bucks? Absolutely not. It can be a disadvantage because honestly, I find that many Ivy League guys, and I went to an Ivy League at Columbia, but a lot of the ones that I've dealt with, they overthink and the analysis paralysis, and they never pull the trigger on anything, and they always underperform because they're afraid of making mistakes because their entire life to get into an Ivy was about not making any mistakes and getting an A on every single test. And it's the old joke, the guys who got the C's employ the ones who got the A's and the B's. So Hayden, my best advice to you is if you're hungry, go after it and get it. And don't worry whether you went to an Ivy League school or not. It might be harder to get in the door, but take out their garbage for 2 years. Eventually they'll get to like you if you're any good, and you'll find your break. So Arid Goler, hi Tom, your podcast is amazing. Wanted to get your opinion on Brazil and its current economic state. I'm considering investing in some companies there, but I'm uncertain about the country's reliability. So we're looking at it. We haven't found anything we can pound the table on yet, and we're willing to miss it because we have enough exposure through emerging markets and the dollar trade with Alibaba. But we keep an eye on it. I mean, Buffett has tiny positions in Nubank, NU, and StoneCo, STNE. I don't know if it's him or if it's subordinates. I think it'll probably work. I don't love taking country and company risk, and both of those companies are a little small. I'd rather a bigger company, but I can't find anything I love, and I already have the exposure. So if Brazil's not going to take off without Alibaba doubling or tripling. So I'm not losing sleep over not being in Brazil, but I am keeping an eye and trying to dig around and see if there's anything I like. But it's basically the same trade as Alibaba, so I'm not eager to put it on because I already have enough Alibaba, and I'm excited about that. Steve Taylor. Yo, Tom. Okay. Yeah, I'd like your opinion of Henderson Far East Income Limited. There's a book, First Western Guy Investing in China, blah, blah, blah. Dividend-based fund that's beaten down heavily. I don't invest or analyze in funds. I buy companies and cash flows, but thanks for the question and thanks for following. Ross R. What is your experience with general market downturns and how they affect undervalued stocks like BABA or Citi? If overvalued stocks like Nvidia and Tesla fall hard due to higher for longer rates or whatever, how are the value stocks usually affected? Do they usually follow suit with a deep pullback as well? I know anything can happen. Just wondering what your experience has been. So actually, in the late 2000s, when tech was going bananas and you couldn't give away value stocks like Procter & Gamble and banks and all that stuff, Buffett was buying them hand over fist, and there were magazine covers that said, has Buffett lost his touch? He's underperformed for 5 years. He doesn't know what he's doing anymore. The world has changed. It's based on eyeballs or some other bullshit, metric. But at the end of the day, from 2000 to 2003, when the NASDAQ fell 80 or 90%, I think it was up 30% a year for those 3 years while the rest of the market was crashing. I think even the S&P was down 50 and he was still up big time. So to answer your question is, yes, when the market goes down, most everything goes down, but sometimes things are so cheap or there's a rotation. So I would say, for me, it doesn't matter. I mean, the bottom line is, I've bought one of the best businesses in the world at the lowest price it's ever been available. So I don't really think about that. If it goes down 5% because the market goes down 10%, or if it goes down 15% because the market, I don't lose sleep over it. I would lose sleep if all of a sudden their cash flows start eroding or something along those lines. But the fact that the country's been locked down for 3 years and the cash flows have been fine, once they pull out the bazooka, Alibaba's the toll taker. So if they pull out a bazooka, with $100 billion, $10 billion is going to find its way into Alibaba's coffers, more or less. I mean, it's just insane the size that they have and the impact that they have on that market. So Rasa, a good question, but not really relevant. if you're investing in a rational way, like Seth Klarman was talking about at the beginning of this. Drew Byrne, grateful for your thought. Hope you had a nice Independence Day. Grateful for your thoughts on UK and Germany listed TUI as a low percentage portfolio option. TUI, I don't know what that is. All right, let's take a look. Overview. Where's the description here? Oh, here it is. Provides tourism services worldwide. Operates hotels under the Robinson Rue, Blue Diamond, Magic Life brands. Company's also involved in tour operation and airlines businesses. TUI. Ooh, this is interesting. They must have bankruptcy risk here because they're generating cash, generating free cash flow. What's the balance sheet look like? They paid down a little bit of debt. Capital leases. This is kind of interesting. Revenues are growing. Must have done an acquisition. They had a big jump in revenues. There must have been an acquisition that people don't like or it's not integrating fast. Oh, no. This was just down from COVID. So they're losing money, but they're free cash flow positive. I like this tourism recovery story. Key is, why was it declining well before COVID? So it was down 80% before COVID. I'm going to look into this. I think this is a good idea, Drew, but this is going to take more than just, looking at the financials. There's something here that people are afraid of this thing going bankruptcy, and I just don't see it in a cursory look at their numbers. So, let me just see here. TUI. I do like travel and tourism. I don't think it's going to be dropping off a cliff anytime soon. So I just have to understand. So the first thing I would do is I'd read their annual report. I would listen to 4 or 5 of the last few conference calls, see if there have been any management changes, big acquisitions, what's the bull case, what's the bear case. This looks like it's probably more of a trade than an investment because it's very cyclical in nature. It's not like a super high quality business, but that's not to say you can't make, multi-bagger here. So I like it. I'm going to do a little more work on it during the week, but let's see what tourism. Oh, okay. You said it's large worldwide tourism hit hard by the pandemic, recently paid off government debt assistance with some recent year-on-year business volume improvement, has a good deal of debt, has recently refinanced significantly to 2026, also has recent share dilution. Okay. So let's just see. So it could be down 90% because they have 10x the amount of shares, which is a problem. I mean, it's not an unsolvable problem. Yeah, so here we go. Their share counts increased 300%, but that's a lot more. I mean, as this generates cash, they can start to buy that in as they, they'll buy in debt, they'll buy in shares. So it's not going to be an overnight story. So you're betting between the next 3 years before the debt comes due, they're cash flow positive. They bought in some of the shares. You think the debt business overrides the upside potential? I think, Drew, the way that you can manage these is just by position sizing. Because if it's a potential 3 or 4 bagger, and you put 2%, the risk might be warranted. But anyway, more work has to be done. I think you're very clever in pointing this one out. I'm not a yes on it, but I'm very interested on it, and it's going to take a lot more work. So if you do some more work, why don't you do this after you go through the annual report and a few conference calls? I'll probably look at some of that myself. Send me if you have any increased thoughts. If you find anything bearish, I'm more interested on the bearish story than the bullish story. I do like the fact that it's UK. I want some more UK exposure because no one wants it right now. But that's very, very interesting work. And Drew, as many of you know, has been an avid follower for 2 or 3 years. He comments every single week, shares it every single week, and it's evident in his thought processes. Noah Garcia Munger is quoted saying that value investing isn't popular because it's not easy during the past 24 months. Let's see, value investing not easier. Can you offer some tips on handling market despondency, which is where the thing... The way you handle the emotions is just by understanding the numbers. If you understand the numbers, you don't get caught up in that nonsense of people chasing around price like a dog chasing their tail. I mean, when you know what you're buying and you know where it historically trades and should trade, and it's trading, 1 or 2 or 3 standard deviations below that, you don't have a lot to think about. You just wait. It's a waiting game, and that's what you're paid for. Like I always say, they're not going to give you multi-baggers for free. They're going to test your metal, and you're going to keep rechecking your work, and it keeps confirming that you're spot on. Then you just wait. And, like the guys from Legatum we interviewed that turned 10 million into 5 billion over 5 years. For those of you who haven't seen that interview from last July, go into the YouTube channel and the Hedge Fund Tips YouTube channel, and then search in the channel Legatum or Philip Vasiliou, who is their CIO, who I interviewed for an hour, and you'll learn a lot. But the Richard Chandler, one of the brothers, when they were sovereign, he had a lot of positions that went against him before he went for him, but he knew he was right, so he took up golf and he just waited for them to turn, and that's how you turn 10 million into 5 billion over 20 years. So it's just patient. Paul Falcon, hope you had a great 4th. Have you looked at Nike lately? It's 40% off all-time highs. Return on invested capital strong. Margins have come under pressure. Love to see it get cheaper, but it seems like a high-quality business that might get incredibly cheap. Just curious on your view of Nike right now. I think it's a good trade right now. It's not going to become a position in the portfolio, but I've been watching Nike and Starbucks as a China trade, but I have enough China exposure that I don't need to do it. The thing about Nike is that I think it is a good long-term hold. In the short term, their earnings estimates have come down a lot. I think they're going to be disproven in the second half when China rebounds really quickly. As a matter of fact, China was the only bright spot in their most recent conference call. Sales dramatically exceeded expectations in China. So, but if you look at estimates in the last 60 days, they've come down, you're looking at 15% for current year 2024 and about 20% for the following year. And yet the stock has only come down. Do I have it daily here? I don't know. The stock hadn't come down enough over the same period. I think it works as a trade. I think I'm in the same boat with you, Paul. I'd like to see it get cheaper before I consider it as a long-term position for taxable accounts. Jay Jones, but thanks for the question, and I think your thinking is right there. Jay Jones, for a declining U.S. dollar in a second half regime, what basket of stocks or U.S. ETF with multinational exposure would be ways to express this view? We don't do really ETFs with the exception of biotech because biotech, you're buying lottery tickets on drug approvals and takeouts, and it's better to buy the lottery tickets in a basket so you're guaranteed to win versus with that, you want to just look on a company by company basis, and we've covered a lot of them. The ones that get a huge portion of their revenue from abroad that are high quality, that are currently on sale, that's where you want to focus. Okay, we covered that. Kayla Smith. Hi, Tom, longtime viewer and fan of the show. What are your thoughts on Netgear? It looks deep value and was on Benjamin Graham's net stocks. I don't know what that is, but thank you. All right, Netgear. Gosh, don't they make routers from the 80s or something like that? Let's take a look. All right. Okay, so it's down to $14 from 46. Good start. A lady after my heart, buying some beaten down thing that no one wants at the moment. But let's see if the beatdown is justified or hopefully temporary. Okay, so so it's generating some cash. It really took a hit 2022 and 2023. That's probably related to everyone buying the electronics in COVID, and then they had too much inventory. Not dissimilar from Generac, and now they're working through that, and then they'll get to a normalized basis. So let's just make sure that's true. Yeah, sales spiked like crazy, up 30% in 2020, and now they've been reverting back, and then they overshot on the downside. Networking products, Wi-Fi standards help my ultimately timely shares. Yeah, so you really just have to get comfortable that they've got a product lineup and a demand that it will, in fact, revert, and not that this is a secular decliner, that this is a cyclical thing. This looks like exactly the business that would be a cyclical thing. And I have a sense that this is going to be a decent trade, Kayla. Hold, I don't know. It's always been kind of a cyclical business, as you can see. It doesn't really trend. It just overshoots and undershoots. It seems to be the trend with this stock. But i.e. a low-quality business, which is probably confirmed by what they earn on their capital. Let's take a look. Yeah, I mean, it's always been a mid-single-digit business. So it's a low-quality, competitive business. Margins are down a little bit, but they're still around 30%. Let's take a look at cash flow. So they're burning through some cash short term while they work through those inventories. Yeah, you really have to get comfort from management that why is the downturn in sales temporary versus permanent, cyclical versus secular? And then the balance sheet, as long as they can stay in business. Capital leases, do they not have any debt? Doesn't look like they have any debt. Yeah, they're not issued. Oh, total debt, $44 million. They took on a little bit of debt. How much cash they have? $143 million. You know, Kayla, I think this is pretty good, but you got to get comfort around this being a cyclical thing, that they're working through inventories. I'm betting 90% that that's the problem, in which case you have a trade. And you probably have at least, I would trade it for a double maybe once you get that confidence. It seems okay, and I think your idea is pretty good. But again, know what you're getting. This is not a quality business that you're going to hold for a while. It's more of a trade. So with that said, I want to thank everyone for tuning in. We'll be back next week, same time, same place. In the meantime, make it a great one. Bye for now.